Chapters 2 and 3 make up our second unit of study, Unit B. Chapter 2 provides a basic review of financial statements. It's an accounting review. And in many cases, the numbers we use in finance come from accounting statements. So it's critical that we, as finance students, understand what's contained in the major financial statements available and where those numbers come from. Chapter 2 will be covered in two segments. In Part A, we'll focus on the main financial statements and the concept and computation of free cash flow. This figure comes from Chapter 1, and it's repeated throughout the chapters we'll cover to put in perspective what part of the process of calculating intrinsic value that we're working on. As a quick review, a firm's financial filings must contain four statements. The income statement gets us to the bottom line. The balance sheet, a snapshot of financial position. The statement of stockholders' equity reconciles net income with dividends and retained earnings. And the statement of cash flows, where cash came from and where it went. Our mini case involves Computron Industries, a manufacturer of computer components. The company doubled its plant capacity, opened new sales offices outside its home territory, and launched an expensive advertising campaign. Computron's results were not satisfactory, to put it mildly. The board of directors was most upset when they learned how the expansion was going. You've been brought in and given the job of assistant to Computron's chairman to try to find out what's wrong and what needs to be done to fix the problems. As you can see, Computron's stock price declined from $50 to $30 a share. Unhappy shareholders. Dividends also declined. The following slides outline Computron's financial situation. Sales did increase, but net income declined due to increases in cost of goods sold, other expenses, and interest. Sales increased by $500 million, 9%. Interest payments increased by 59%, and net income fell by $105 million. That pretty well says it all. This is Computron's balance sheet. We'll look at assets and liabilities separately. Both total assets and net fixed assets increased by about 20%. AR and inventory increased about 30%. Cash and short-term investments fell. Recapping. Current assets and net fixed assets each grew by over 20%, much more than sales grew. Accounts receivable and inventory almost doubled. They're taking longer to collect, or they have unsold products or unused raw materials in warehouses, and cash and short-term investments fell. Liabilities did not fare well either. Accounts payable increased by 1/3, notes payable increased 5-fold, and the firm took on more long-term debt. Current liabilities increased as creditors and suppliers financed part of the expansion. Long-term debt increased to help finance the expansion, but the company didn't issue any stock. The statement of cash flows reconciles the accounting data from the income statement and balance sheet with cash, which is the major concern in finance. What cash did the firm have at the beginning of the period? What did they do to bring in or spend cash? And what do they have at the end? As you'll recall, the statement of cash flows is divided into three sections: operating activities, investing activities, and financing activities. This is the section on operating activities. It begins with net income and adds sources of cash, depreciation, accounts payable, accruals, and it subtracts uses of cash, accounts receivable, and inventories. Since Computron expanded significantly, it's no surprise that they spent a lot to acquire new fixed assets. To finance the expansion, they issued notes payable and new long-term debt. Note that even though the firm's net income declined, they continued to pay a dividend to keep the shareholders relatively happy. Looking at the statement of cash flows all on one page, the large acquisition of fixed assets drove the negative investing number. The financing section details how these losses and acquisitions were funded, through new debt and some cash. This recap of the bottom lines of each segment emphasizes where the cash went. This slide recaps our conclusions from the statement of cash flows. Positive net cash flow from operations. It was dragged down by the big net increase in working capital. Negative net cash flow from investing. Small increase due to selling short-term investments, bigger decrease due to large fixed asset expenditures. Net cash flow from financing. Big increase in borrowing. Even after borrowing, the cash account fell. Free cash flow is not net income, but it is related. A company's value clearly depends on its ability to generate free cash flow. If a firm generates positive free cash flow, there are several possible uses for it, most of which will increase the stock price and the value of the firm. They could pay interest on their debt. They could pay back some of the debt. They could pay dividends. They can buy back stock. They could buy assets, invest the money. This figure from the text details the 5 steps needed to calculate free cash flow. We're going to walk through each step on the following slides. Step 1. Compute NOPAT, net operating profit after taxes. Using Computron's numbers, we find that their NOPAT for 2018 and 19. Step 2 requires us to find net operating working capital. Remember, net operating working capital is operating current assets minus operating current liabilities. Operating eliminates short-term investments from current assets as these are not operations related. Step 2 continued. As with current assets, operating current liabilities excludes notes payable. The typical definition of net working capital, current assets minus current liabilities, isn't applicable here. Net operating working capital includes only operating accounts. Here we find Computron's net operating working capital for 2018 and 19. Note that it increased in 2019. Step 3. Total net operating capital is equal to net operating working capital from the previous slide plus net fixed assets. You can see the calculations for both years on this slide. Steps 4 and 5. Step 4 computes the change in total net operating capital, which is the difference between 2018 and 19 from the previous slide. Finally, Step 5 results in free cash flow. NOPAT minus net investment in operating capital. Computron's free cash flow for 2019 was a negative $425 million. Not good. Here's where that $425 million negative free cash flow was used. Primarily the increase in debt. This ends Part A of Chapter 2. To complete our analysis of Computron's expansion, we'll move on to Part B.